All right, welcome back, everybody. Chevron hosting its Investor Day right here in New York today. And joining us ahead of that is Mike Wirth. He is Chevron's chairman and CEO. Mike, thank you for coming into set today.
Welcome.
There are a lot of things that Wall Street wants to hear from you today. I think they're looking at updates on the Hess acquisition that was announced in July. And really, your plans for growth, because 6 months ago, people would look at it and say there's not a lot of places for growth, but the table has changed drastically. There are a lot of places that you've got things to work on and that you are going to be showing growth. So what is your message to shareholders today? What are you going to be leading with?
Our message is Chevron is bigger, stronger, and better than ever. We're going to be growing free cash flow and earnings through the end of this decade and beyond. Free cash flow will grow at a 10% compound annual growth rate, underpinned by a strong portfolio. We've got a track record of growing shareholder distributions over the next 5 years. At a $70 oil price, we could return 45% of our market cap to shareholders through dividends and share repurchases. So we've got a strong story of capital discipline, cost discipline, steady growth, and cash returns to shareholders.
Yeah, earnings per share, you're looking at growth better than 10% annually if Brent stays above $70 through 2030. I guess let's start with that assumption. $70 is above where oil prices are today. I think 65 is the latest on Brent, just under that, 64.48. So what gets you to $70 when you look at the global supply out there?
Well, we're seeing the current market weighed down a little bit, but primarily by the return of OPEC plus barrels that have been held off the market. And so prices, as we move into 2026, are likely to reflect that additional supply. You get beyond 2026 and things come back into balance. And so this is a guidance out to 2030. And I think it's reasonable over that period of time that we're going to see a recovery in commodity markets. And 70 is probably a bit of a conservative assumption if you're looking out through the end of the decade.
What happens if oil prices are lower for whatever reason? How do you change your assumptions?
Our break even to cover our capital spending and our dividends will be below $50. So we're well positioned for a low cycle. Even at a $60 price, our free cash flow, if you look at last year versus the coming year, will triple from 2024 to 2026 at a $60 oil price. So our underlying portfolio strength and growth is resilient even in a low price environment. Of course, we've got a AA credit rating, so a very strong balance sheet that we can lean on if it were to be a longer cycle.
You're actually now talking about reducing CapEx through 2030 with a reduced range of $18 to $21 billion a year. But I think you're planning on increasing production even with that lower CapEx.
We're growing production at a 2 to 3% compound annual growth rate. Demand in the world is growing at about 1%. So we're growing a little bit stronger than overall demand is. At $1 billion a year less capital spending. We also announced $1 billion in further cost cuts. We increased our synergies on the Hess transaction by 50% from $1 billion to $1.5 billion. So continued cost and capital discipline are necessary in this industry, and the plan we're laying out delivers that.